Why most SCHD investors are getting it wrong and how to fix it. What if I told you that many SCHD investors are making critical mistakes that could cost them thousands, even millions of dollars in lost returns? SCHD is one of the most popular dividend ETFs, but most people don't use it correctly. Some chase high yields, some fail to diversify, and others ignore key portfolio adjustments. And these mistakes could be holding back your financial future. But here's the good news. If you know exactly what to do, SCHD can become a powerful wealth-building machine, generating steady passive income, long-term portfolio growth, and even setting you up for a stress-free retirement. Imagine turning the cost of a daily coffee into $1 million portfolio, avoiding the pitfalls that could slow your investments down, and learning a simple, proven strategy that builds wealth while you sleep. In this video, I'll break down the 10 biggest mistakes SCHD investors make, and more importantly, I'll show you how to fix them. By the end, you'll discover a simple $7 a day investment strategy that could grow into $938,000. All thanks to dividend growth, reinvestment, and the power of compounding. So, stick around, because what you're about to learn could change the way you invest forever. SCHD, a great ETF, but are you using it correctly? Many believe SCHD is a set it and forget it investment, but that oversimplified approach can lead to missed opportunities and financial setbacks. SCHD is a strong dividend ETF, but blindly investing in it without a strategy could hurt your long-term returns. Mistake 1. Focusing only on high yield and ignoring growth. A high dividend yield sounds appealing, but if dividends don't grow, your income loses value over time. SCHD excels in dividend growth with a 5-year CAGR of 11.59%, while the average ETF grows only 4.77%. Solution: reinvest dividends to maximize compounding growth, turning dividends into additional shares that generate even more income over time. Mistake 2. Trying to time the market instead of investing consistently. Many investors wait for the perfect time to buy, but market timing almost never works. Instead, use dollar cost averaging, DCA, investing consistently, regardless of market swings. When prices are low, you buy more shares. When prices are high, you buy fewer. Over time, this balances out your cost and lowers risk. This strategy removes emotion and ensures you're always in the market, benefiting from long-term growth. Mistake 3. Ignoring SCHD's holdings and hidden risks. SCHD may hold over 100 companies, but that doesn't mean it's well diversified. It is heavily concentrated in financials, 18.85%, and industrials, 11.35%, meaning a banking crisis could significantly impact returns. An economic slowdown could hurt industrials, dragging down SCHD's performance. Solution: always check SCHD's sector exposure to understand where your money is concentrated. Mistake 4. Relying only on SCHD and missing out on growth. SCHD only includes US dividend-paying stocks, which means you're missing out on key opportunities. 1. International markets. No exposure to major global dividend payers like Nestle, Toyota, or Samsung. 2. High-growth tech stocks. SCHD's tech allocation is only 10.22%, meaning you're missing out on fast-growing giants like Amazon, Google, and Tesla. 3. Non-dividend companies. Some of the biggest stock market winners don't pay dividends, so SCHD doesn't include them. Solution: to strengthen your portfolio, consider adding international ETFs, VX U.S, VWO, for exposure to global markets. Tech ETFs, QQQ, VGT, to capture high-growth companies. Total market ETFs, VTI, for a mix of dividend and non-dividend stocks. SCHD rebalancing, a crucial but overlooked factor. Even if you diversify, many investors ignore SCHD's quarterly rebalancing, which can impact your portfolio more than you think. Mistake 5. Not tracking SCHD's portfolio changes. Every 3 months, SCHD sells and adds stocks based on strict criteria. If you're not paying attention, a company you liked might be removed for failing dividend growth or financial standards. New stocks can shift sector exposure, changing the fund's risk profile. You could be investing blindly, unaware of key adjustments. How SCHD selects stocks. SCHD tracks 100 top US dividend-paying companies, selecting stocks that pay dividends for 10+ years, show strong financial growth, profitability, dividend growth, and debt management, can sustain and grow dividends long-term. Each quarter, SCHD rebalances to prevent over-concentration, maintaining diversification. The bottom line? Check SCHD's updated holdings each quarter to stay aligned with your goals. Up next, a critical mistake that could cost you big. SCHD rebalancing, balancing yield, quality and risk. SCHD adjusts its holdings every 3 months to prevent overexposure to any one company or sector. No single stock exceeds 4 to 4.5% of the fund. No sector makes up more than 25%. Mistake 6. Ignoring rebalancing and its impact. SCHD doesn't just chase higher yields, it prioritizes quality, ensuring companies have strong financials and sustainable dividends. Ignoring these changes can impact your portfolio. A high-yield stock might be removed, lowering your dividend income. A new stock with growth potential but a lower yield could increase portfolio value but reduce short-term payouts. Mistake 7. Chasing hot stocks and abandoning strategy. During a bull market, it's tempting to ditch SCHD for high-flying stocks, but jumping in and out can derail your long-term wealth-building strategy. The bottom line? Stay committed, track rebalancing, and focus on long-term financial growth. Next up, another critical mistake to avoid. SCHD versus individual stocks. Understanding the difference. Some investors compare SCHD to high-growth stocks like Tesla, but this misunderstands their purpose. Mistake 8. Treating SCHD like a stock. SCHD is an ETF holding multiple dividend-paying companies, offering stability and diversification. If one company struggles, others help balance the risk. Tesla versus SCHD. Key differences. Tesla, high growth, volatile, price swings based on news and leadership. SCHD, steady growth, reliable dividends, less risk during downturns. Why this matters? Tesla saw explosive gains, but also extreme volatility. SCHD won't skyrocket like Tesla, but it won't crash as hard either. Choosing between the two depends on your risk tolerance and investing goals. The bottom line, SCHD is about consistency and income, not rapid growth. Understanding the difference helps you make smarter investment choices. Up next, another costly mistake investors make. Don't miss it. Short-term versus long-term. Why patience wins with SCHD. Comparing SCHD to Tesla is like comparing a reliable sedan to a Formula One racing car. One is built for stability, the other for speed and high risk. Mistake 9. Focusing too much on short-term returns. Looking at short-term performance can be misleading. For example, last month, SCHD returned 1.87%, slightly below the ETF median of 2.26%. Over 3 years, SCHD delivered 18.27%, outperforming the median by 22.58%. Over 5 years, SCHD returned 74.93%, nearly doubling the median return of 37.73%. Why this matters? SCHD is not designed to deliver fast, explosive growth. It's built for steady, long-term wealth creation. Zooming out reveals its true strength, consistent compounding returns. The bottom line, patience is key. Stay invested, reinvest dividends, and watch your portfolio grow over time. Up next, how investing just the cost of a daily coffee can lead to a $1 million portfolio. Adjusting your SCHD strategy as you age. Mistake 10, sticking to the same strategy at every life stage. Your investment approach should evolve as you get older. When you're young, you can take more risks, but as retirement nears, the focus should shift to wealth preservation and steady income. How SCHD can fund your retirement. Starting at age 30, $10,000 initial investment, reinvesting dividends. By age 60, portfolio grows to $464,215, generating $2,000 to $3,000 per month. Starting at age 50, $200,000 initial investment grows to $619,568 in 10 years. Higher starting capital compensates for less time, but risk increases. A simple $7 a day plan for long-term wealth. You don't need a huge lump sum. By investing just $7 a day in SCHD, you can gradually build a strong passive income stream without needing a massive upfront investment. The bottom line, your investment strategy should adjust with age. Start early, reinvest dividends, and stay consistent to secure long-term financial freedom. Next up, a final secret to maximizing your SCHD investments: the power of dividend growth and compounding. A simple $7 a day investment in SCHD could snowball into a massive portfolio, all thanks to dividend growth and compounding. How small investments grow over time. Year 5, $16,156. Year 10, $45,211. Year 20, $208,807. Year 30, $938,235. Total contributions, $76,650. Capital appreciation, $442,228. Reinvested dividends, $419,257. Total added value, $861,585. Your money works for you, earning returns on both investments and growing dividends. Final takeaway: build wealth with SCHD the right way. SCHD isn't just another ETF, it's a proven wealth-building tool when used correctly. By avoiding the common mistakes we covered, reinvesting dividends and investing consistently, you're setting yourself up for serious financial success. Think about it. By simply investing $7 a day, you could grow a portfolio worth $938,000. That's the power of compounding and dividend growth working for you. What's next? Your financial freedom starts today. So what's stopping you from making this happen? If you want to start building passive income, take action today. Set up your SCHD investments, automate your contributions, and let time do the heavy lifting. Drop a comment below. What's your SCHD strategy? Are you already investing, or are you just getting started? Let's discuss. This video is for educational and informational purposes only and should not be considered financial advice. I am not a financial advisor, so always do your own research and consult a professional before making any investment decisions. If you found this valuable, please tap that like button, subscribe, and I'll see you in the next video. Your journey to financial freedom continues, and I'm excited to be a part of it. Here's to your investing success. Profitable investing.